Hey there, I'm Jeff with CreditCards.com. Today we're talking about balance transfer credit cards. We'll talk about what they are, the four main elements of a balance transfer credit card, and then some of the frequently asked questions out there, including how they might impact your credit. So we'll cover most of what you need to know about balance transfer credit cards, but of course, I can't fit every single thing into this video. So if you have any questions, if there's anything left unanswered, check out our website, CreditCards.com. I'll even have our full guide to the best balance transfer credit cards for you down below in the description. So check out all the links down there if you want to see some maybe specific recommendations, or again, if you're hunting for an answer to a question that I don't answer. All right, so first things first, what is a balance transfer credit card? Well, it's a credit card that's designed for you to consolidate all of your credit card debt onto one card and pay down that debt quickly. So rather than continuing to make minimum payments on your existing credit cards, maybe you have 1, 2, 3, 4 credit cards, and we all know how vicious the interest rates can be on credit cards. And once you start carrying a balance, it becomes harder and harder to pay down your credit card debt. So the idea here is that the balance transfer credit card will buy you just a little bit of breathing room so you can entirely or significantly reduce your debt. And I think for a lot of people, they are a really good option, although they're not your only option for reducing debt. I'm sure we have more guides about that on our website. By the way, if you enjoy the video and you realize how much hard work we put in, we'd really appreciate a thumbs up. And you can always subscribe to our channel for more videos like this one. All right, so let's cover the four main elements of a balance transfer credit card. You have the introductory APR and period, you have the ongoing APR, you have the balance transfer fee, and the annual fee. So typically with a balance transfer credit card, the main reason you would end up getting one of those credit cards is that they have an introductory period whereby you pay 0% interest on any balances you transfer over for a set duration of time. So usually it's anywhere from 10 months to 20 months, somewhere around there. And for that introductory period, on the balances that you transfer over, you won't be paying any interest. So again, it's kind of like breathing room. You get the credit card, you transfer over as much of your debt as you possibly can, and then during that introductory period, you are just throwing money at that credit card. You're trying to reduce that debt, because after that introductory period is over, you go back to the ongoing normal APR, which can be really expensive. I mean, maybe 12% on the low end, maybe 25% kind of is an average of what you'll see sort of on the higher end, but it becomes extremely expensive. So you want during that introductory period to pay down all or most of your credit card debt. So I personally think that a balance transfer credit card can be incredibly advantageous, but you have to have a lot of self-discipline. You cannot slack off. You have to take advantage of that introductory period. And then also remember that when you transfer over a balance, typically with a lot of cards, there is a balance transfer fee. It's anywhere from maybe 3%. That's kind of the average. Sometimes we see 5%. Generally, the minimum balance transfer fee is $5, but there are some cards that don't charge a balance transfer fee, but they will have their own downsides, right? Maybe they have a shorter introductory period or a higher ongoing APR. So there's kind of pros and cons to everything. I do think we have a guide about the cards that don't charge a balance transfer fee, and I'll try to link that for you down below in the description. So just to go over a quick example, let's say you have $7,000 in credit card debt across a couple of different credit cards. You take that debt, you transfer it to a new card. Generally in that process, there's a fee. Like I said, maybe 3%, maybe 5%, definitely a minimum of $5, or maybe nothing, depending on the card you go with. If you have $7,000 and the fee is 3%, that means that your balance is not $7,000, it's $7,210. So just keep in mind, a lot of times there is a fee that's very common. Now, speaking of fees, let's talk about the annual fee. Oftentimes you will see cards that have a $0 annual fee. Sometimes it's maybe a $95 annual fee. It's something to factor in. I think our guide to the best balance transfer fee credit cards specifically discusses annual fees for all the different credit cards, and a lot of them do not have an annual fee, but just make sure you look into that before you sign up for a new card. All right, so now let's cover some of the frequently asked questions that we see out there. And the first is, what is the minimum credit score required to qualify for a balance transfer fee credit card? I would say generally you need a pretty good credit score. You know, the banks and the issuers, they want to make sure that whoever they're taking this leap of faith with has really good credit and will be able to pay them back. So I would say the minimum credit score is somewhere around a 670. That said, on our website, we do give specific guidance about a lot of the different cards as to what the minimum or recommended credit score is. So that might be worth checking out. But I would say easy rule of thumb, 670. And you know what? Something that might be interesting to you is our card match tool. It's totally free and it's on our website. You can see if you have any maybe pre-qualified things or any special offers. It's worth trying at least once, and I'll link that for you guys down below in the description. All right, next up, a lot of people have questions about what type of debt can be transferred to a balance transfer credit card. Usually it is just exclusively credit card debt. You can't take your auto loan, your student loans and consolidate them. It's just taking the balance from some credit cards onto another credit card. Usually you want to set up a new relationship at a new financial institution and then transfer your balance to that new card at that new institution. It's kind of a perk of giving them your business, right? Your existing bank doesn't want to do it with you, but the new ones might be willing to do it again if you have good credit history and a good credit score. So just keep in mind, it is purely credit card debt, and then you'll probably need to go outside of your existing financial institution. Next up, how much debt can be transferred to your new balance transfer credit card? This is something that a lot of people overlook, but it's very important because there is no guarantee that your new balance transfer credit card will have a credit limit high enough to absorb all of your existing credit card debt. So let's say you have $7,000 in credit card debt and your new balance transfer credit card only has a limit of $5,000. You can only transfer $5,000. And if there is a fee, you got to account for that fee as well. So there is no guarantee that your debt will match your new credit card limit. So just keep an eye out for that before you sign up for a new credit card. And speaking of signing up for a new credit card, how will getting a balance transfer credit card impact your credit score? This is really important. I know we've done a guide talking about it specifically. I'll link that down below in the description. The short answer, the quick answer is that getting the balance transfer credit card or taking advantage of one will both help and hurt your credit score. It will hurt your credit score in the short term, but generally help your credit score in the long term. So when you are signing up for the new credit card, usually in that application process, there is a hard credit inquiry, which is a negative ding on your credit score, your credit report. Eventually that'll roll off, but in the short term, it does negatively impact your credit score. Also, if you're approved, you'll be opening up yet another line of credit, which means that the average age of all your credit will go down, right? Because if you have two cards, they're each a couple of years old, and then you sign up for a new card that's obviously brand new, it'll drag the average down a little bit. And the average length of your credit is a factor in your overall credit score. Obviously, over time, when you're being responsible with your credit card, and as time goes on, then the average age will go back up, but in the short term, it does impact you negatively. Now, on the positive side, by signing up for a new credit card, theoretically, you should be getting a larger aggregate credit limit. So let's say, again, you're $7,000 in debt, you've got a couple of different credit cards, and your total credit limit right now is $10,000. Your credit utilization ratio is 70%, and that is a major factor in your credit score. It's usually accepted, by the way, that your overall credit utilization ratio, meaning how much you borrow divided by your total credit limit, is 30% of your overall credit score. So if you have a 70% credit utilization ratio, that is horrendous. But if you sign up for the new credit card and you are approved, then you'll be getting a new credit card and your utilization ratio should go down because your overall credit limit goes up. Let's say your new credit limit for your new credit card is $7,000. Then obviously your credit utilization goes down because you have $7,000 on top as how much you're borrowing and $17,000 as your overall credit limit. So your utilization drops from 70% down to 41%. That's still not good, but it's clearly a much better position to be in. Now, the one thing I forgot to mention is that your utilization for a single line of credit matters as well. So generally you want to keep your utilization on each piece of credit as low as possible. And then the other more obvious way that a balance transfer credit card will positively impact your credit is that over time, hopefully during that introductory period, you are going to massively reduce your debt. Now, 41% is still a high utilization ratio, but your goal is to reduce that over time. And that's the obvious advantage with a balance transfer credit card, is that it's gonna allow you the breathing room to significantly reduce your debt. So let's stay with that same example. You have $7,000 in current credit card debt, and let's say you sign up for a balance transfer credit card. The intro period is 15 months, whereby you're paying 0% interest. And you really tighten down your belt and you decide you're gonna throw $350 a month for 15 months at your credit card debt. That means at the end of the 15 months, your debt is no longer $7,000, it's $1,750. And your overall credit utilization is no longer 70% or 41%, it's about 10%. which is pretty good, and you should see a nice bump to your credit score. So that is a big way to improve your credit. And then clearly you have more flexibility in life because now you have significantly less overall credit card debt. So that's what you need to know about balance transfer credit cards. Obviously, I didn't cover everything. I think balance transfer credit cards can be helpful. They can also be abused. It just depends on how you're going to use them and your particular circumstances. So if you have any questions, write us down below in the comments. You can always go to CreditCards.com. And I'll have more resources for you down below in the description. I hope we earned your thumbs up and you're now a subscriber to our channel. Have a great day.